6:15 and we're going to start class. Looks like I have a few people joining in the waiting room, and I have everybody there. Just a quick test before we get started. Just a second, we'll get there. It's on the syllabus. The time of the exam is on the syllabus. It's October 6th, by the way. So there are people asking when is the first midterm? It's October 6th. Is on the syllabus, and we'll talk about it next class. So before we get there, though, we have a little bit more upgraded technology in the classroom today. So what I would like you to tell me if you can hear me okay, or you hear me lower, like, so for the first time, I'm not screaming, and because we have a microphone in the room. And so I just want to make sure that you guys can hear me okay, even though I'm not, like, I have a normal tone of voice. Yes? Good, excellent. Oh, yes. My vocal cords are very thankful, and probably the ears of people in the classroom too. All right, good morning. Today we're gonna start talking about, accounts receivable, cash and cash equivalents. But before we do that, it's Friday, so I wish everybody is doing well. And here in Boston, for people that are in Boston, it's a great day. Wonderful to be outside. So I hope you guys will get to enjoy some of that. Also, as far as homework, let me know if you have any questions, any issues. I hope by now you guys are in a routine. Have you used MyLab before in your classes? Yes. So, I mean, it looks like most of you did. So I'm hoping that there's nothing new about MyLab. We also, some people are more comfortable doing reviews on, formats that are different from MyLabs. So we have posted the solution manual of all the questions in the back of your book. So you have that available to you if you want to practice further for the exam. And yeah, I mean, that's pretty much, hopefully that helps. And also, another thing that I wanted to tell you is, again, we're going to talk about the exam extensively next week. I just got off a meeting with the rest of the team that teaches AC 221, and we're going to come, back with like instructions and things that have to be done for the exam. But basically, the exam is going to be online. Just because we are getting close to the date, I want to remind you to please look at your syllabus, because the week of the exam, it will be a little bit quote unquote off in terms of class meetings. So we are not meeting on October 5th, which is Monday, because typically, we use our class meetings also for exams. But in that case, because this is a coordinated course, we are going to take the exam. All the courses, all the sections of AC 221 will take the course at the same time. And so we'll take the exam, at the same time. So basically, what's going to happen is that the exam will be on Tuesday, the 6th. And we are not going to, in order to avoid to have 4 class meetings in a week, we'll skip the class meeting of Monday, because the one of Tuesday, the exam of Tuesday will be in lieu of class meeting of Monday, pretty much. So we're now meeting Monday, Tuesday for the exam, Wednesday, and Friday. We're meeting only 3 times as we are supposed to. So please sort of make sure that you mark that on your calendar. As far as the exam time, will be to be confirmed, but it should be at 7 p.m. from 7 to 8 p.m. on Tuesday. And like I said, it will be remote, open books, open notes, and you guys will be connected to Zoom. So you should be, we'll talk about it more next week, because frankly, in the agenda of today, I have, oh, I have people joining. In the agenda of today, there's no really that much time to talk about the exam, also because really I want to give you more detailed information, which I'll have more next week from our coordinator. All right, so having said that, what we're going to discuss today is accounts receivable, cash and cash equivalents. Before we do that, 5 minutes, is anything, there's anything that you want to discuss? How is it going with this hybrid experience? I mean, is it working? I mean, and again, it's okay to say, again, it's a Friday afternoon, morning. It's we are somewhat relaxed in a way, so it's okay to be like, I hate it, I don't like it. I mean, does it work to have, you know, this sort of like a connection from the classroom to your remote place? Does it make sense? Is it working okay? Even for people that join live, I mean, and as you know, we have plenty of seats available, so feel free to drop off at any class. I mean, there's a wishful thinking that I have that I hope one day I'll be able to see you in person, to meet you in person. But again, like I know some of you are physically not in Boston, but for those of you who are and you'd like to join us, that would be great. But you know, if you have any questions or any concern or any thoughts about like how is your hybrid experience going, let me know. I mean, and you can email me, you can come to office hours, and also what I would say is I will probably send you a survey, an anonymous survey to do at some point. So just make sure that you complete that survey because it helps me to figure out how I'm supposed to adjust to like a teaching modality that is novel to all of us. So anyhow, so having said that, let's get started with cash equivalents and accounts receivable. And let's go from there. All right. All right. Okay, so it's kind of awkward because we put down like cash and then receivable and revenue, but really we have like a little, just one slide or a little bit more, like a couple of slides on cash. But it's just a way of sort of helping you to get a sense of what's in cash. All right, so let's talk about the roadmap. As you know, I am a fan of the roadmaps just because I think, especially at this stage of learning accounting, it's good for you to get a sense of like what are we doing and why we're doing it. And so we have talked about, you know, the financial statement construction, and what we're going to be focusing today is cash and accounts receivable and revenue, especially when it goes to accounts receivable. So again, like then the following that we're going to be tackling is inventory, and the prediction would be that it's either next, like it's going to be either towards the end of next week or after the exam, depending on, you know, how we're doing on a receivable. And one thing that I want to say is that receivable is typically the first item that is a little bit challenging for accounting. So don't feel like this is a lot, I don't understand. I mean, just come to office hours, or if my office hours are not, you know, good for you, like there's plenty of tutors, but you're gonna find this to be a bit challenging as a chapter, I think. Then I feel like there's a little bit of both, like getting adjusted and also topics that are a bit more simple to tackle. But the challenge of accounts receivable is that you could have so many scenarios that we might not be necessarily covering in class. But typically, I get students that raise their hand and say, "But what about this? And what about this other scenario?" So what we do is we cover the scenarios that are the most common, but then in the appendix of the chapter, we try to show what else can happen with accounts receivable. So hopefully that helps you answer most of your questions. All right, so again, cash and accounts receivable, and we'll talk about revenue. We'll spend time talking about revenue recognition. And in fact, after we talk about cash, we're going to start focusing on revenue. And then in the following class meetings, we'll talk about accounts receivable. All right, as far as, debits and credits and T accounts, what happens is that we have, cash and cash equivalents, as we know, is an asset. And then we're going to be talking about sales and the relationship with accounts receivable, which is another asset. Then we'll talk about allowance for uncollectible accounts and its relationship with the uncollectible accounts expenses. And the reason why my arrow go that way is not just because I randomly picked it and I kind of liked that order. It's because there's a logic. I first make a sale, and then depending on whether or not my sale is on account or on cash, then I may have an account receivable or might have cash. Whereas when I estimate the allowance for uncollectible accounts, which means, yes, the client owes me $100,000, but turns out the client, unfortunately, say COVID-19 pandemic, has issues paying me, and you're going to see this a lot in the financial statements of companies, I bet like at the end of December, but we have seen it throughout the last few quarters. It's going to be like a situation where the client owes me $100,000, but it already told me I can't pay you only $80,000, and so that $20,000 becomes an uncollectible account. And then how that works, it goes into allowance for uncollectible expenses, which again, it's typically an estimated amount. We're going to go over that extensively over the next few classes, but it starts from the balance sheet. It starts from the balance sheet where I sort of estimate how much are my uncollectibles, and then based on that, how much are my uncollectible accounts receivable, and based on that, I then understand like how much has to be my uncollectible expense. So that's why the errors are that way. The accounts receivable minus the allowance for doubtful account gives me the net accounts receivable, which is typically what you're going to find in the balance sheet, which is pretty much this. Like you have cash and cash equivalent, and then you see afterwards accounts receivable net, which we're going to tackle in a minute. One thing that I wanted to say when looking at the allowance for accounts receivable, we're going to talk extensively about it, but just so you know, it's a contra asset account. It's booked in the asset, but it works with increasing, by debit and increasing by credit and increasing by debit. I'm sorry, increasing by credit and decreasing by debit. So we'll talk about that in due course. Any questions so far before we move on and we talk about cash? Okay. So cash. Cash is the item that we expect to be liquidated. So as we know, current assets are expected to be liquidated all within the next 12 months. And cash is the first item typically, which we're going to be talking about. And then there could be investment, account receivable, inventory. Each line has a different value rule. Now, I have to pause on this because also for purposes of the exam, so we typically ask you, and you will need to go back and look at the slides of previous chapters to remember the order of the accounts. But I don't want you to go and look at the balance sheet of companies and say, you taught me that I have to remember that cash comes before accounts receivable, and accounts receivable comes before of inventory, and then there's prepaid expenses. And you taught me that that has to be the order, period, the end. And then you come back to me and you're like, but if I look at Amazon, that's not the way it's done, because inventory is listed before accounts receivable. So you're making this whole thing up. I suppose the answer to that question would be, we're both right. Me and whoever put together the financial statements of Amazon. Reason being is I tried to tell you what is the order that is typically used for the majority of the companies to classify their current assets. However, the philosophical thought is that you have to classify the current assets by liquidity. So if in your business, liquidity means that inventory is more liquid than accounts receivable, and if you think about it, businesses, Amazon, that's true, because you buy, the inventory gets shipped and you collect right away. And it's true for a lot of companies in the same industry, then it's okay, because really the current assets have to be classified by liquidity. What happens in the majority of the circumstances is that the most liquid current assets after cash is accounts receivable. That's why I kind of, that's why I give you that as an example of what you should master for your exam. But again, there might be a circumstance where that's not the case. And what you need to think is that the reason why it's not the case, because evidently for that business, inventory, I'm making inventory example just because that's what we're talking about, inventory is more liquid than accounts receivable. So just as an FYI. All right, as far as cash, the only reading that I had assigned is page 224 of chapter 4. Nothing more. We're gonna talk extensively about cash because guess what? We're gonna talk about the statement of cash flow. So we'll spend a lot of quality time on, not necessarily on cash classification, which is what we're going to be talking about today, but like cash changes, cash, how cash increases and decreases over time. Today, we're just focusing on, on where cash is classified, and that's pretty much it. And then receivable net, and why is it net? Because it's basically accounts receivable minus allowance for doubtful accounts. And you'll notice that throughout, the semester, you'll notice that we'll have some accounts that are expressed as a net. That's because typically they are, they have a contra asset account associated. So for example, if I'm looking at these financial statements, I noticed that property, plant, and equivalent has a net. And then finance lease right of use as a net. Property under capital and financing obligation as a net. So that means that those accounts have either a contra account or they have a value, like they have an object account that decreases them. And that's why they are expressed as a net. So again, for today, we're going to be, for this section, we're going to be focusing on the accounts receivable, and that will teach you a lot about how to look and read financial statements in general. So cash, yes, Franju.
I just want to ask what the 10K means.
What, I'm sorry?
On the previous page, there's a Walmart 10K.
What is a 10K?
Yeah.
Anybody has an answer for that question? Anybody knows what a 10K is? No? Okay. Well, that's a great question. And the 10K is the annual report of companies, publicly traded companies. It's called the 10K. And it's the name given by the Stock Exchange Commission and the SEC, and whereas on a quarterly basis, companies file a 10Q, Q for quarter. So that is, yeah, so that's typically the way we refer to financial statements. And again, this is true for publicly traded companies. We don't call it 10K for non-private publicly traded companies, just because the 10K refers to the report that the publicly traded companies have to file with the SEC. And so, yeah, it's the filing has certain rules, and so it says your 10K needs to contain this, 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 and this. And so typically we use interchangeably the word 10K and annual report. But when we talk instead of quarterly reports, it's 10Qs. And again, for publicly traded companies. That's a wonderful question, because sometimes we sort of feel, you know, like you forget that certain things have to be specified. All right, so cash, reporting cash on the balance sheet. Cash and cash equivalent. So you have cash. What is the equivalent? Like you can have checking accounts, saving accounts, and then time deposits that are less than 3 months until maturity, certificate of deposit, and high trade, like very low risk securities. US government securities, everything that is really has a maturity that is below 3 months. That's what you consider as cash or cash equivalent. And that's about that, just about what we're going to be talking about, cash, because again, the intent here is just giving you a sense of how you report it and what goes into it. Then when it comes to how cash changes over time, like I said, we refer to the cash flow statement. Now we're going to talk about receivable and revenue. We start typically from the income statement. So we start from revenue recognition. Then we talk about sales return and allowances, which I would encourage you to sort of write down the process. I mean, you'll see the slides posted, but so just to follow what I'm saying, I would encourage you to sort of write down the process so that you have a sense of like the sequence. But we'll start with revenue recognition, and then talk about sales return and allowances, and then the uncollectible receivable. It's a big chunk that we're going to tackle in the next classes. So, like just overarching concept, the accounts receivable is the dollar value that we are owed if we are a company from customers for prior sales. But so if we are owed the money from prior sales, it makes sense that we first talk about the sales and then we talk about the accounts receivable. Just because also with sales, a lot of things can happen. What if I give a discount? You know, we'll learn that also sales is a net value, because we learned there will be also contra revenue accounts when it comes to sales. So here is another roadmap. I like to develop those just because they give you a big picture of what we're talking about. So sales and revenue net, and we'll discuss why. Because, like I said, there are contra revenue accounts, and how we're going to connect that with the accounts receivable less allowance for uncollectible accounts, which you can call it like that, or you can call it accounts receivable net. You know, it's either one or the other. So here I'm giving you an income statement and a balance sheet, and pretty much I want to point out to you which portion are we going to tackle today. So why, you know, we talked about revenue recognition, but why revenue recognition is so important. So there are like revenue and net income are really the most important performance metrics that people that like investors look and try to figure out, like at first glance, they try to figure out like the performance of the company. If I want to see how the company is performing, the first thing that I'm going to do is look at how big are their sales, how much they increased from the previous year, which is an information that I can gather easily from my financials because the income statement will have a comparison year over year. And well, we'll show year next, the previous and the current year and the same financial statement. And then the net income, how much money the company made in terms of performance, in terms of adding value to the company, how much did they make this year? Because that, we learned that the net income is going to be instrumental for my earning per shares. So again, revenue change net income and investment prices just because it is so fundamental. I mean, it gives me a sense of like, how is my business going if my revenue volume goes up. So beginning of 2018, for publicly traded companies, which were the first one that had to comply, they were the so-called early adopters. And the 2019 for other companies, there was a revenue recognition principle that came about. It's not that before there was no revenue recognition rule, don't get me wrong, but at that point of time, it has been discussed for years, with FASB. And for people that have been, I mean, I wasn't personally involved, but I participated to conferences where people had submitted letters as far as like FASB came up with a proposal, and people, like companies, have submitted letters of saying, this is good, this is not good. So it was a very lengthy process, and it was by far probably like the biggest accounting principle revision that had been done in the last 10 years, if not more, frankly. And the reason why this was necessary is because over the years, if you think about 20 years ago, I'm hoping not from personal law, I suppose not from personal knowledge because you guys are very young, but even thinking about it, the way people were doing business is very different from now. There wasn't such a thing as I need to go grocery, let me do Instacart, or let me go on Amazon and get food from Whole Foods. There wasn't such a thing as like, I need my cable, I'll go buy it online, or I need clothing and there's so much opportunity online that I don't even need to go to a store. You can buy online pretty much everything today. But that wasn't happening 20 years ago or more. And so the way revenue were recognized was based on what businesses, like the way businesses were functioning. With new businesses and new trends of businesses coming up, it was really difficult to keep up with so how these people have to recognize revenue. And so that created a little bit of a dilemma, and which again prompted to come up with revenue recognition, also because some companies would come up with would have material misstatements and errors in their financials, but not intentionally. It's because there was no point of reference of how they had to recognize their revenue. So the idea is, let's come up with 5 steps, and I'm going to list them over here. So for those of you who like to take notes, I personally do. I type them, but and I get always aggravated if I don't have enough time to write notes. But basically, there are 5 steps of the process. First of all, you identify the contracts with the customer. So is there an agreement of what am I going to deliver with a customer? So let's have a contract, or let's have some sort of an agreement that tells me what am I supposed to perform. Identify the separate performance obligations in the contract. So what am I supposed to do? And are they, identify them step by step. I'm going to give you an example. Construction company, that's the easiest to think about, sort of to come to this example. As a construction company, I'm asked to perform the revamping of a building, say in the downtown Boston. I'm going to renovate that building. And so with the trustee of the building, I'm going to discuss what is that you want me to do. And then based on what is it you want me to do, I'm going to identify different steps. And this is good also for, practical management of a contract. So I'm going to redo the lobby, and then I'm going to redo the common spaces, and then I'm going to redo the hallways of each and every floor, and I'm going to be responsible for installing new elevators, and then I'm going to redo the roof deck. Great. For each and every of these transactions, I'm going to set up a price. Why do you guys think that could be important? That I set up a price for when I'm done doing the lobby? And this is philosophy of accounting. It has nothing to do with debits and credits. It's more to do with critical thinking. Why would it be so important that I say the lobby is going to cost $20,000? Well, if I think about revenue recognition, when do I recognize revenue typically? When I earn them. So if I'm done building the lobby, it would be nice to be able to bill for that and have a price of reference. So that if somebody comes back and says, why did you recognize sales for $20,000? Well, I have a contract that says that if the lobby is finished and the client accepts the lobby, whatever I've done in the lobby, I can recognize $20,000 of revenue because I've earned it. I've done my work. So that's why. I mean, it seems like practical, but there's really an element of revenue recognition. When do you earn it? So again, that's why, like at number 4, it tells you allocate the transaction price to all different separate obligations. And then you recognize the revenue. So I'll be able to recognize my revenue when I'm done with the lobby, which is good because then I can bill the client and get paid. Otherwise, I would just come up with like, well, you know what? I think I had this much cost, and I think this should be, whatever should be the sale price. And you can go back and forth. And really, from a financial statement standpoint, which is your obligation to show the market and your investors, look, this is really like, and the auditors, because they'll come check on you, this is really truthful, and these sales really represent what my business has earned so far. That's a very straightforward process right there. Nobody can complain. And again, the last piece, the recognition of revenue when the entity is satisfied, that is what triggers that word revenue when it's earned. If I am satisfied as a client, then the company, the construction company in this case, can say, I have earned my revenue. All right. So how to make it more appealing for the customer to buy a product? You typically, give discounts, give right to return, sell on credit on account, so they have more time to pay you. So let's focus now on, after we've sort of figured out, this is the overarching concept that we are talking about, which is revenue and how do we recognize revenue. Let's think about how do I make this work in terms of how do I increase my sale volume? So what happens if the customers don't pay you? So again, you appeal the customer by giving discounts, right of return, sell on credit, so they have more time to pay. And if they don't pay you, you have to book uncollectible account expenses, which is bad debts. And we talked about that, and we'll continue to talk about that. So we're going to start talking about discounts, which is basically you have a customer that purchases a lot of material from you. And because of that, the customer at some point says, I've been a customer of yours for a long time. Can you give me a discount? And typically common sense will tell you, yes, of course. And but basically, it's typically like you give discounts typically to businesses, not to individuals. But also there, it really depends about the kind of business. Now, we're talking about publicly traded companies, so you would think that their, most of, their transactions and trade discounts will be given to either individuals that are like, have been with the company for a long time, or like more businesses. So the discount is a reduction, like basically it's an amount that is taken out of the gross selling price. So I sell bikes, and my gross selling price is typically $300. But and I'm a wholesaler, which sells to retailers. But because, like a retailer in Watertown who has a ginormous store of bikes, had bought bikes for me for the last 5 years, I'm gonna give them a discount. So the gross price is 300. I'm gonna give them like a 20% discount. So I'll give them $60 discount, which will bring the price of the bike to $240. So that's the idea. It's basically, you simply record the sale at a lower price. So if I say I have a gross selling price of 1,000, less the 5% discount, the net price will be $950. And what you do is you increase your cash, assuming that you have made the sale on cash. You increase the cash by $950, and you increase the sale by $950. Debit, cash, credit, sale. Very easy. Returns though, so again, that's all I have to say as far as discounts. You just book it at the net value. There are, you might find some books that tell you, like other techniques and like more journal entries, but I would just focus on this because this is very straightforward and very simple. Then we talk about returns. So what happens? You have an unhappy customer typically. You've sold a product and the customer is very unhappy. So chances are, the customer may look like this, little boy or girl, I'm not sure, actually, too young to tell, but very upset. It could be the case or not, but regardless, you're gonna have to deal with the return. And, we do returns every day, and I don't think none of us in their wildest imagination has ever thought, oh, gee, how does the company to whom I return merchandise is dealing with this from a financial statement standpoint? I don't do it, and I'm not expecting any of you to do it, but it's good to know, because that's gonna help you understand a little bit better the financial statements. So, what happens is that companies will have an account called sales returns and allowances. And you'll find that it's interesting how you think that you are surprising them with your return, but chances are they have an expectation that some of their sales will be returned. So basically, if the customer might be unhappy or need to return the merchandise, what happens is that the seller might be not satisfied, and basically what it would grant, the seller, may help the customer that is not satisfied by either allowing for the return, so yes, I will let you return the merchandise, or say, I don't know if it ever happened to you, certainly it happened to me, say I don't like the merchandise, and say I tell the company that sold me the merchandise, this is going to be a nightmare for me to return it. Is there a way that it can be fixed? And like the company may say, why don't you? It actually happened to me once with a cardio machine exercise, a cardio exercise machine. Sorry. Basically, I had bought this rowing machine. It came in. It had a little issue that could have been fixed easily. So the company had to send me like a piece to replace, or I could have returned it. But you can imagine, I have to go back and return a rowing machine. So what happened, they told me, we'll send you the piece. How about you keep it and we'll give you a price reduction. We'll add money into your credit card. And that's what I've done. But that's called allowance. So I could have either returned it, or I preferred, just for practicality, to get the extra piece. It was a little I'm not going to go into the details, but they gave me a little replacement of the piece, a replacement of the piece that I needed, and I mounted by myself, and they gave me a price reduction, which again, it would be called sales allowance. Not to be confused, guys, with the allowance for doubtful account that we're going to talk about in the following classes. It's a different thing. This is a sales allowance, that's allowance for doubtful account. I know the semantic might throw you off, but that's not, you just need to learn which one is what. So how should we record this? How should we record this transaction? Because remember, everything translates into transactions. So basically, I'm going to give you a step-by-step, which might be, might make roll your eyes because you're like, oh no, this is too much. But then if we go and look at the transaction, you realize it's not as bad. So you, first of all, think about it. If I get returns, what happens is that I have to reduce my net sales because I didn't make a sale of 1,000 anymore because I'm getting the merchandise back. And basically, how do you reduce your sales is you don't reduce the actual gross value of sales. You use contract and revenue accounts to do so. Why do you think we keep the gross revenue intact? Anybody? Annika, you can unmute yourself.
Because that's what it's valued at.
That's what? I'm sorry?
That's what it's valued at, like the product itself.
Yeah,
like
and the reason why we're going to keep it valued like that, it's for forecasting purposes. Think about it. We're talking about financial account management. Financial accounting. But if you're thinking about it from a managerial accounting standpoint, if you then need to project your revenue over time, you want to get a sense of like, what is my gross revenue, and if I have to trend them up, how much, how much that value would be. Somebody could say, well, but if you get returns, yes, you'll trend the returns too. But the reason why you have them separated is because you want to have a sense of monitoring of your returns for quality purposes. Because at some point, if your returns is going up, you may say, why is this happening? Decision making. You use the financial statements to make decisions. And so internally, the company may say, there's something that we need to check here. So that's why you keep them separate. So we're going to use a contra revenue account. We're going to record and accrued liabilities for sales revenue expected to be given back to customers. So companies, maybe you knew this already, but they do have an expectation of returns. They do expect for you to return the merchandise based on previous statistics. Increase inventory because you're gonna, if you expect to have the return of the merchandise, then you're gonna expect to have the inventory increase again by the value of the merchandise return. And you're gonna reduce the cost of goods sold because there's the expectation that if that sale really didn't happen, I'm gonna have cost of goods sold that will, I'm gonna have net sales reduced, and matching principle, I have to reduce the cost of goods sold as well. So that I match the actual revenue with the expected revenue with the expected cost of goods sold associated with that revenue. So with that in mind, why do we, let's pause for a moment, number 2. So we reduce the sale with a contra revenue account. We accrue a liability to say, of all the sales that we typically made, I'm expecting that X percentage will be returned, and I have the obligation to give back the money to the customer. We increase the inventory by the amount that we expect that will be returned, and we decrease the cost of goods sold by the same amount. So our revenue, expected revenue, matches with the expected cost of goods sold, and we can satisfy the matching principle. All right, so let's make an example. Red Terrier has $100,000 of sales for cash. Cost of inventory sold is $50,000. No prior allowance for returns was recorded. I'm gonna stop right here because the rest that we have over here, guys, we're gonna look at in the following slides. And I don't want you to be overwhelmed by this. So I'm gonna stop just right there. So here you go. This is my transaction. I will increase cash because I have, like I said, I'm stopping right here. I'm going to increase cash because I made a sale for cash, and I'm going to increase revenue. And then I'm going to increase the cost of goods sold by 50,000 as I'm increasing the inventory. Now, to go into next slide, and that's easy. I mean, I don't think we need to comment on it. So now I have $100,000 of revenue, $50,000 of cost of goods sold, gross margin, a gross profit of $50,000. So, So now let's keep reading. Based from here, here you go, from here on. Based on historical experience, RED estimates that 20% of the items it sells eventually are returned for a reason or another. And again, I'm going to stop here. So I made the sale, and now I'm estimating that 20% of my sales are returned. Remember, what did we say? We book a contra revenue account, sales and return for allowances, which will reduce my $100,000 revenue by 20,000, which is what is expected that will be returned. I'm accruing for liability, sales refunds payable. The L over here, guys, the L that you see over here stands for liability. So I'm showing that I'm going to have an obligation to pay, perhaps later on, that liability. And we'll talk about how that liability works at the beginning of next class. Then I'm going to, like I said, I'll increase the inventory, but into a separate account for what I estimate the returns will be. So why it's 10,000? Because it's 10,000, it's 20% of my cost of goods sold, and I reduce my cost of goods sold of 10,000. So what I've done here, I have reduced the sales by the expected returns, created a liability for what I'm expected to give back to the clients, increase the inventory from what I expect to get back as inventory, and decrease the cost of goods sold by the amount that, again, I'm expected that is not going to be a cost of goods, so part of my sales for, a part of my inventory sold for that particular fiscal year. So, as I said, sales return and allowance is a contra revenue account. That's why typically revenue is presented as a net. Just looking at time, we'll do the sequence of this transaction, and then we'll finish up. So, oops, let me go back and erase this. Here you go. Unfortunately, it doesn't work any. Okay, so now we're going to talk about the last piece of this, of what happens over here. Later in the current year, in the current period, we estimated 20,000. Later in the current period, 10,000 of sales were returned to RED. So I estimated 20,000, and so far, 10,000 was returned. So how would I record it? Remember, if I decrease the cost of goods sold, if I decrease the revenue, I'm impacting already the income statement. So at that point, first and foremost, I have to reduce my obligation to, return $20,000 by 10,000, because I'm getting a return right now. I had estimated an obligation to pay back 20,000. Now I'm going to decrease by the amount that I'm actually giving back, which is 10,000 at this point of time. Inventory will increase because I'm getting, the rowing machine back, which didn't cost $10,000, I can assure you, but I am bringing back that rowing machine in my factory, so I have that physically I have that inventory in my warehouse, And I'm going to reduce that inventory returns estimated, because that inventory estimated is no longer a return estimated, it's an actual inventory that has been returned. So I reduce one inventory account that is returns estimated, and I increase the actual inventory because that amount is no longer estimated, is actually an actual one. So inventory estimated, it's an adjunct account, and basically they are like the accounts of inventory are and inventory estimated are typically considered together. So what we discussed really pertains to the last part of this example. We're going to wrap up over here, but what I wanted to say, just to keep, not to keep people in the limbo, and we're going to continue to talk about this next class, is some of you may ask, legitimately so, well, what happens if I don't have as many returns as I estimate? The answer would be the liability account will be evaluated on a periodic basis to see, do I have enough money into that liability account, which is pretty much a reserve? Do I have enough money to account for all my estimated returns? If you do, then you keep it as is. If you don't, you replenish it, which means if you have $3,000 left, like in this case, let's make this case. If I have $10,000 left from the previous period, and then in the following period, I realize I actually need $15,000 of expected returns, I'll replenish the account just by 5, because I already have 10. So you really evaluate it as you go, and you replenish it as you need it. And that's what we're going to be focusing on, like I said, next class. So, and then we'll move on to talk about accounts receivable. So again, any questions, let me know. You'll see these slides posted, and you'll see also the recordings. And I hope you guys have a great weekend, and we'll talk next class. Thank you. Bye.
Thank you.
Thank you.
Thank you.